Welcome to the Trading with Venus podcast, where we help you establish strong trading habits, generate consistent profits, and create the lifestyle you desire for yourself and your family. Now your host, Raman Gill.
Welcome to Trading with Venus podcast, episode 56. I am your host, Raman Gill. One of the questions I hear often is, how do I trade the news? Personally, I don't trade the news. I'm essentially a day trader, so I tend to stay out of the currency when the news comes out for that particular currency. However, that may not be possible for everyone, especially when you're trading long term. Therefore, I've invited our special guest today to answer that particular question for us. Our guest today is Rob Colville. While chatting with him, I mentioned this question to him. Because this question is not a quick one to answer, he was kind enough to put together a presentation for us. Rob was a guest on our previous show, episode 10. If you'd like to hear his trading journey, I invite you to check out episode 10. For now, let's go over to Rob and learn how to trade the news.
Okay, this is the news I'm talking about. First of all, before we start this webinar in earnest, I would like to give a big thank you to Raman for inviting me on today. It's not often that I get to unleash myself to the world at large, and it's always nice to have the opportunity to do so. And I have a lot of fun in doing this and spreading the word, essentially. A lot of people actually ask me how to trade the news, and generally the answer does shock them. And this webinar is going to be dedicated to teaching you how you can trade the news in any market, any asset class, without, ironically, actually knowing what the news is or even caring what it is. Okay, so for those of you who don't know me, my name is Robert Colville. I founded the online trading brand, The LazyTrader, back in 2012. I've been trading for about 10 years now, and believe me, when I first started in this industry, I was probably the worst trader you could ever not hope to meet. I have made every single mistake in the book several times over, and some more. Okay, so don't worry, you're in good company. I learned from the school of hard knocks, and of course, with the aid of decent mentors, Larry Pasavento and Julian McCree, to name but a few, I have established my own trading style, which I have crafted around my life, which enables me to trade from as little as 10 to 20 minutes a day maximum. And if I can do it, so can you. Okay, I got pretty average grades at school. I certainly am no mathematician. I am not very good when it comes to science or equations. So if I can do it, you can certainly do it as well. Before discovering trading, I was actually a journalist earning not very much money at all. And the fact that trading can be used, or can and was used as a vehicle by people out there making money on a residual basis or on a residual basis, was very appealing to me. So I did jack in my career as a journalist. I used to freelance for a variety of publications and did become a trader. Not full time, I was working at other businesses as well, but the intellectual fascination with trading wasn't really there for me. I just wanted to use financial markets as a vehicle to generating wealth, and that's exactly what I'm doing. I became consistent about a couple of years after first starting, after blowing up numerous accounts, and fast forward about 8 to 10 years, I now trade currencies, stocks and commodities, and since establishing the brand LazyTrader.com, I've taught thousands of people around the world how to trade from as little as 10 minutes a day. And the great thing about trading in this style is that it frees up time. They say that time is the most valuable thing you can ever give anyone. So the more of it you have, the better it is, not just for you. If you've got passion and purpose, the world at large as well. Okay, so hobbies when I'm not trading and I'm not doing the Lazy Trader, maintaining our online community. I enjoy traveling, tennis. I do a bit of mentoring for the Prince's Trust, which is a UK-based charity which teaches people from disadvantaged backgrounds how to expand their business. Okay, so anyway, that's enough about me. I'm pretty sure you didn't take time out of your day to listen to me prattle on about myself. So without further ado, let's talk about how news affects the markets. This is what essentially I'm going to cover in this webinar. Common misconceptions with news trading. the ingredients to successful news trading, why we don't care about the news, how to risk manage, and how essentially we can position ourselves in advance of key news announcements so that we can win big and lose small. So first things first, how does news affect the market? Well, essentially the market moves according to the difference between what is expected in terms of a news release, the publication of a figure or anything like that, and what is already factored into the market. Okay, so say for example, manufacturing figures for the United Kingdom are worse than expected, then you can expect, say for example, the FTSE, which is Britain's national index, and the British pound to fall. But if it is released as expected, you can expect relatively no change. If, for example, manufacturing figures are better than expected, then you can expect the British pound and the FTSE to rise in accordance with this. Okay, so it really does depend. The movement of the market depends on the difference between what the market is expecting and what the actual figure is released. Okay, so if the news is better than expected, then the associated asset class will go up as investors gain confidence. But if it is worse than expected, then you can expect the asset classes associated with it, generally risk-on asset classes, then you can expect a drop in the value of it. Okay, and I can certainly tell you that do not go relying on newspapers or magazines for news in terms of dictating your trading ideas, because you can be rest assured that the market has already factored in the news and has made an adjustment accordingly. So please do not wait for the Financial Times to come out on Sunday for you to make that decision on whether you're going to buy or sell oil, or indeed that stock which is just essentially released better than expected news with regards to kind of a new CEO or earnings figures being better than expected. Okay, so what we do is we essentially use the news as a catalyst to help our winning trades win big and our losing trades to lose small. So we only risk a small amount per trade. Okay, there are a lot of misconceptions about the news, but I just really want to emphasize this point. We use positive reward to risk in every trade we take, providing it fulfills our rules for entry, so that if the 50-50, the news is in our favour or against us, if we are right, that 50% chance we are right, we are rewarded handsomely by more than we risked on the trade. But if we've, say for example, 50-50 chances there that we are wrong and the news goes against our trade, then at least we lose small. This is a theme we will revisit, okay? And it's not essentially a strategy I'm teaching you, it's a concept. But before we get onto that, I just want to talk to you about many misconceptions which I want to bulldoze, because a lot of people really do get it wrong when it comes to news trading. Do I have to be exceptionally smart or mathematically gifted to trade the news profitably? Absolutely not. As we'll demonstrate a little bit later on, there are some basic maths, but it really is subtraction and addition and division. That's it, really. Basic GCSE pre-16 years of age maths. Are there people that get it right all the time? Absolutely not. There are some people that get it right some of the time, some people that get it right most of the time, but there is absolutely no one on this planet who has or ever will or ever has been will get it right the whole time. All right, so you can forget that. Do I need to tune into CNN, Bloomberg, the BBC? Absolutely not. In fact, it's best that you don't do this, because these outlets will confuse you more. It's an absolute constant drain being plugged into these news feeds, where you're going to get typically, say for example on Bloomberg, you'll get someone in the morning talking up the US dollar. By lunchtime, somebody else will be talking down the US dollar. By evening, someone will be on the fence. By nighttime, nobody knows. Okay, so do not do this, because it will be absolutely exhausting when you've got people of varying accolades or varying kind of credentials will just thrust their 2 pence worth into the forum. And of course, the market is a market for a reason. Everyone's got different ideas. Okay, so if you can get onto the same side as the smart money, i.e. the money with influence in the market, then that's fantastic. Again, last but not least, is there the holy grail when it comes to trading and investing? Absolutely not. I thought this did exist in my earlier phases as a trader, but I can certainly say, having travelled the world over and foraged and scoured the earth for the holy grail, unfortunately, that has been a futile mission. Okay, so is it really possible to make a decent return trading the news? Yes, it is. Let me show you how. That is the crucial element. But I just want to talk to you about the components that make successful news trading. First of all, you need a profitable strategy. It does not need to be complicated. A lot of people fall into this trap of thinking that the better the strategy, the more complicated it has to be. That's absolute nonsense. In fact, strategies which are as old as the hills have been proven to work time and again. You do not need to sign up to some expensive EA or spaceship system with lots of flashing lights and indicators to be profitable. That's absolutely not the case. A stable time frame will help, like the daily and the weekly time frame, which is essentially a time frame which is immune to a lot of intraday news announcements and these inexplicable spikes that you see. Positive reward to risk, a big one. So for example, if you are risking, say 1% of your trading account, whatever that might be, whether it's £100,000 or dollars, whether it's £1,000 or dollars, you want to be rest assured that for your 1% of risk, you want to be making more than 1%, like 2 or 3% preferably. Okay, it is absolutely crucial to get this. Risk management, key as ever. For those of you who are unfamiliar with the concept, then I would encourage you to look around this and expand your further reading. It's basically the process by which we enable only small losses, worst case scenario, on our trading account. It means that we do not lose, in our case, more than 1 or 2% of our trading account, and it's a predetermined amount depending on the size of our account that we do not lose in excess of for every trade, no matter how good or bad it looks if it goes the wrong way. A stop loss is an order which we place with our broker, which means that we can exit the position if it goes against us without wiping out our whole account. And last but not least, it's the ability to sit back, forget, and relax. A lot of people forget to do this when they place their trade. They're forever monitoring it and fiddling with the trade. Just simply forget about it and rationalize in your mind that, hey, this is the best case scenario that happens. If it does go my way, if it doesn't go in my favor, then at least I've only lost 1 or 2% of my trading account. When I say 1 or 2%, I always encourage people to risk maximum 1% once they've had 6 months consistent results, i.e. if they're able to show a net gain after 6 months of trading, then expand it to 2%. That's what I always encourage people. When it comes to a profitable strategy, it doesn't really matter what it is, whether it's a trend or reversal, a bounce or a breakout, as long as it's got a positive reward to risk profile, that's key. The daily or weekly charts, the higher order time frames, a lot of people complain to me, hey, well, if I'm trading in this time frame, it means that I've got a much bigger difference between my entry and my stop loss. Absolutely, that's the exact reason why we trade it. It means that you've got a much bigger distance between your entry and your stop loss, and you can afford to be offside. If, for example, intraday news spike or some kind of spike of manipulation or anything like that does cause you to go against your trade momentarily, at least you're not spiked out and the market, to your horror, goes in your favor. You can afford for the market to be offside for a bit before potentially it goes in your favor. Okay, so the higher order timeframes as well means that we can take advantage of longer moves, bigger moves. We can benefit from higher profits even though they're fewer in frequency. Positive reward to risk, we've already discussed this. We only take trades that have the potential to offer us a higher return than what we risked. This is absolutely key. Risk management, no more than 1%, or if you have over 6 months consistent profits, 2%, absolutely fine. Always use a stop loss. If you go bungee jumping, you're not going to do it without a cord. This is my analogy. So no matter how good the trade looks, sometimes even the perfect looking trade loses you money. So this is why it's absolutely crucial. No exceptions to this rule. The great news is that if you're trading the daily or the weekly time frame, it's essentially a time frame that doesn't need constant monitoring and management. So it enables you to have the time to just sit back and relax and do whatever you please in the interim until you do have to manage the trade. And this will depend according to your strategy. Okay, your strategy is rules to management or rules for management. Don't get suckered into continually trailing your stop loss, for example. A lot of people do this when they see that flash in the pan, that glimmer of profit. They'll always be moving their stop loss until the market spikes them out at a small, tiny gain, and to their horror, they'll watch the trade go in their favour, plus some more. But the only problem is they won't be in the move, and that sucks. You don't want to be in that position at all. Okay, so just to recap, we want a profitable strategy, a stable time frame, i.e. the daily or the weekly, positive reward to risk management, no more than 2% or 1% before you're consistent. Always use a stop loss. If your broker does not offer this facility, it's highly unlikely that they won't. But if they don't, or they don't make it mandatory, then you might want to reconsider. The ability to sit back, relax and forget, that will come with time. Okay, so just to really expand on the risk management, you need to keep the risk low. 1% of your trading account. Don't risk more than that. I know it's very tempting if you've got a smaller account, say if you've got like a £500 or dollar account, 1% of 500 is 5. It's so tempting to a lot of people to risk more than that because they say, hey, well, you know, I'm only going to lose £5 or $5 if it's wrong. That's nominal. It doesn't matter. Old habits die hard. And if you can get, even though it might sound tedious and boring, like the maths worked out to begin with, like no more than 1%, no matter how big or how small your trading account is, then you'll be head and shoulders above a lot of amateurs out there who end up just betting their house on a trade because they're egotistically invested in the move. Okay, so any client of mine who risk more than 1% before they're consistently profitable, I set them a punishment, and that can range from reading Gordon Brown's autobiography. Gordon Brown is the ex-British Prime Minister, by the way, who's an exceptionally boring man in my personal opinion, so that is worth a punishment. That's a very worthy punishment. Okay, so essentially to come to 1% of your trading account, no matter what it is, it should be a rolling value of your account, whatever it is, just move it down 2 decimal places and that will arrive at 1% of your trading account, the figure that is. And what we then do is we then divide that figure by the difference between our entry price and our stop loss. Okay, so in terms of trade sizing, say for example, we've got a £10,000 or $10,000 trading account and we've got a difference between 50 pips between our entry price and our stop loss, then all we do is we risk £2 per pip because we divide 100 by 50. So that is trade sizing. Okay, so in terms of reward to risk, we want, obviously, the potential reward to outweigh what we've got risked on the trade. And we'll show you a few examples of this in a minute, okay? And it's very important at this stage to basically look at the chart and assess what is reasonably achieved by the market versus what we want to happen. A lot of people, when they go to selecting a target for their trade, they inadvertently just go over arbitrary number or figure what they want the market to do based on their wildest fantasies. We want to base our target and therefore our reward potential based on what is likely to happen versus what we want to happen. That is absolutely crucial, ladies and gentlemen. Okay, so this is why we don't care about the news at all. Well, the great news is if we're trading with the daily and the weekly time frame, which is what we trade exclusively, it means that we are more immune to the news and these kind of intraday fluctuations, and we are trading probabilities according to price action. We can leave the trade to run, and we basically analyze the charts according to the story the chart is telling us, rather than simply pontificating and posturing over the fundamentals like a lot of these longer term hedge funds do, who have hundreds of thousands of dollars and pounds to spend on research. Of course, they can't get it right the whole time. Okay, as retail traders, we do not have access to inner circle government circles, central banks and or lawmakers, and we are very much at peace with the fact that we cannot predict the news right all the time, some of the time, or maybe not the whole time. But what we could do, thanks to analysing the chart and looking for opportunities which offer high profit potential where only a small amount is risked, is that we can essentially manipulate things so that if we are right, then we can be rewarded handsomely, and if we're wrong, thanks to our risk management and using the stop loss, then we can only lose a maximum of 1 or 2% of our trading account. Okay, we are at peace with the fact that, okay, it's very 50-50 if the news goes in our favour or it doesn't. But if, say 50-50, it does go in our favour, then we can make 3% because news will help to move the market and act as a catalyst in our direction. Then that's fantastic. And if we're wrong, it's a 50-50 chance that if we're wrong, then at least we only lose 1%. Okay, so it's like flipping a coin, heads or tails, knowing that, hey, if we bet heads and we're right, we make, say, £300 or dollars, but if we're wrong and it lands on tails, then we've lost £100 or dollars. Okay, so it's the same principle as flipping a coin, really. Okay, so finding a reward, like I just mentioned, it is absolutely crucial to look at the chart and establish what is likely to happen versus is what we actually want to happen. There's always a big kind of gap between what we want to happen. Of course, we'll want to make the maximum amount of profit possible, and sometimes we do confuse that or fudge the reality of it based on what we want to happen. Okay, and I will tell you that there is a relationship between the higher the reward, the lower the probability is the market of getting there. Okay, so how do we find reward when you look at the charts? Okay, well what we do is we simply look at our entry price and we take away our target price to arrive at a figure, a difference, and we divide that by our entry price minus our stop price. Let's take a look here. Say for example, this is EURGBP. This is a trade we took. We see this bearish pin bar reversal here of our entry just below the low, our stop loss above the high. We've got a 67 pip difference here. But if we're targeting all the way down to the bottom of this well-established range, we have potentially 246 pips reward. Okay, so what we do is we divide 246 by 67. That gives us a 3.6 to 1 reward to risk profile or return. So for example, if we're right and we risk, say, $100 of our $10,000 trading account, then we make $360. And whatever the news is, we don't know or even care. 50-50 that it's in our favour or not. But if we're right, then great, we're rewarded handsomely. If we're wrong, we only lose 1% of our $10,000 or pound trading account, which is £100 or dollars. But if we're right, we make 360. That is a trade worth taking. Same principle when we come to, say, pound versus the Australian dollar. We've got a bullish pin bar reversal here. We've got an entry above the high of this bullish pin bar reversal, stop loss below the low. We are risking 186 pips and we are targeting the previous swing high as we normally do in upward trending markets. 838 pips divided by 186 equals 4.5 to 1. So that is a very healthy reward to risk. And that means that, hey, if we did take that and say, for example, the news, whatever it might be, between getting our verdict, whether it's a gain or a loss, and entering the trade, we don't really care what it is, but if we are right 50-50, then we are potentially fast-tracked to making 4.5% return, risking only 1%. If we're wrong, or the news goes against us, we lose 1%. If we're right, we make 4.5. Simple as that. Okay, so now onto the crucial element of this webinar, how we made money trading the news. Let me show you a few examples. The first one is slightly more relevant than the others. It's the more recent one, it's Brexit. And we actually found a very technical reason to sell the British pound versus the Swiss franc. In December 2015, we sold a bearish pin bar reversal representing a lower high in what we anticipated to be a double top formation at I think the level was about 7 years established. So given the fact that level that's held for 7 years is far more likely to see price ricochet or bounce off it than smash through it, and the technical setup you have before your very eyes, we anticipated that price was more likely to go down than to go up. So what we did, we placed an order to sell at the bottom of this bearish pin bar reversal, stop loss above the high, and we did so. And we had all this profit down here to potentially take advantage of. This was the next level we anticipated just in advance of 1.4600. That was an 18 to 1. We risked 76 pips, 1% of our trading account, or 2% in our case, sorry, and we were targeting 1,404 pips. That's not bad reward to risk. That's worth risking £100 if you know that £1,800 or dollars could be gained in return for that. Okay, so what we did was we simply entered at the top, like I just mentioned, and we saw price go down. This very big long-term move coincided with Brexit, which was in June 2016, and we of course knew that, hey, if the British voted to remain, then the British pound would rally, and if they voted to leave, then the British pound would fall. But we had no idea what the verdict would be, so we knew that very late on into this trade that, okay, it will help to perpetuate a winning trade even further around about here. But if, for example, we were wrong, at least we had time in advance to move our stop loss to break even. Remember, we got into this long-term trade here back in December 2015. We had all this downside here. We sold a couple of rallies in this, what established to be a downward trend inside a very long-term range, roundabout, I believe it was here, and here. So we had a couple of extra jollies along the way, but we had this complex retracement here in the form of an ABCD pattern, and okay, we had an 18-to-1 reward to risk from this very move here, but we did make far more around about here from the other exits we had along the way. So from this entry here, we scaled out at this point the previous swing low, and we had another entry here, exit point the previous swing low. So there was ample opportunity for us to make money along the way, but we had no idea what the British public would vote. And of course, it just so happens the British public voted pro-leave, and that helped what remaining positions we had in the market even more. And of course, that had the British public voted to remain, then we would have not made so much money, but we would have had moved our stop loss to break even, and we would have been very pleased with either result as far as our trading is concerned. Now let's talk about the British general election and how it's affected the British pound versus the Australian dollar. We knew full well that the Conservatives and Labour were neck and neck in the opinion polls in 2015, and we had no idea who was going to win, either David Cameron or Ed Miliband, okay, neck and neck. But one thing we did see was a bullish pin bar reversal on the daily time frame. It was a false breakout, and it was a pullback in an upward trend. If you look on the weekly chart at this point, you'll see the upward trend is very well established. So we simply said that, hey, okay, the election results will be in the night, whether 3, 4, 5 a.m. in the morning. We'll be asleep then. We don't really get up for these things at all. We'd rather just have a peaceful night's sleep, actually. And we knew full well that, hey, okay, 50-50, if the Conservatives were going to win, then at least we can reasonably expect the British pound to rally off the news. And if New Labour won, we can expect the British pound to tank, because the Conservatives are slightly more business-friendly than Labour, traditionally speaking. And so we knew that, okay, 50-50, if we're right, we'll be rewarded handsomely, i.e. the British pound will exceed in value or rise in value against the Australian dollar. But if we're wrong, we lose, 2% of our trading account? No biggie. And so we placed our entry just above the high of the British pin bar reversal, stop loss below the low, and I think we went to bed. And we knew that, okay, the risk was 1% or 2% in our case, risking, say, for example, 173 pips, and the potential profit targeting the previous swing high was 858 pips. So, if we, 50-50, whether the Tories or Labour would have won, who knows, who really cared at the time? Well, I certainly did, but anyway, that's besides the point. But we knew that, hey, if the Tories won, we would have made, say, £490, say, hypothetically example, and if we're wrong, say, we lost 100. No biggie there. It's a flip of the coin, isn't it? If you're heads, you make £490. If you're tails, you lose 100. It's a coin worth flipping. Okay, so that's exactly what we do. We see a price action based setup, we trade it, but only if it's got positive reward to risk, so that if we're right, we know that we can make a good amount of money, but if we're wrong, we only lose, thanks to risk sizing using a stop loss, a relatively smaller amount. Okay, so it did go on to hit target in the end. The Conservatives did win, thank God. And it hit target in the end after with the initial surge, and then we had a retracement and then a continuation to hit target the previous swing high, and then it went in excess of that. Another example is the Scottish referendum, which we had in 2014, which is where, of course, Scotland and Alex Salmond's Scottish National Party cast a referendum in Scotland deciding Scotland's fate in the 300-year-long union which they've had the United Kingdom. Okay, and of course, we knew full well that if the Scots voted for their independence, then that will cause uncertainty. Markets won't like that. You can see the FTSE fall or plummet, should I say, and the British pound subsequently plummet as well. But had the Scots voted to remain inside the union, then we can reasonably expect either not a change or the FTSE to rally and the British pound to rally as well, because that would be the continuation of the status quo, and that's what bankers, investors, hedge fund managers want. They want the continuation of the status quo. It's certainty, it's predictability, and it means that all factors being present are correct can mean what could possibly go wrong. Well, in this case, a breakup of the United Kingdom could cause a lot of uncertainty. But anyway, in terms of the technical story we were given at the time of the Scottish referendum, we saw a bearish pin bar reversal at a multi-year high. This represented a decent selling opportunity for us, being at the top of a well-established long-term range here. It makes far more sense to sell at the top of the range than it does to buy. The bounce is far more likely than the breakout. So what we did was we placed our entry just below the low, stop loss above the high. We're anticipating decent reward to risk. In fact, it was a 8.6 to 1 reward to risk. We were risking 38 points and we were potentially going for 330. So that's 8.6 to 1. And say, for example, if you had, say, £100 risked on this, and, for example, it went in our favour, it would have made £860 return or dollars return. If we'd lost the trade, then we would have lost £100 or dollars. And of course, we would have expected, worst case scenario, Alex Salmond to have won and the Scotland to get their independence. But that didn't happen. So did that happen? Well, we actually, Scotland did vote to remain inside the Union, but the FTSE did just fall anyway. So that was a bit of an anomaly as far as we're concerned, but we were positioned the right side of this trade anyway. Of course, ideologically speaking, I would hate to have seen Scotland leave the Union, but of course, we are positioning ourselves according to the worst case scenario, and the technical story gave us that worst case scenario as well. So we had a confirmation there, technically speaking. We had no idea what the result was going to be. It was quite neck and neck according to opinion polls in the lead up to a referendum, but we knew that, hey, if Scotland voted to leave the Union, then the FTSE would fall and we'll be in the trade and we'll make lots of money. And if they voted to remain in the Union, then the FTSE, technically speaking, we had a decent setup anyway, and it will either rally, would lose money, and or nothing would happen. Okay, so that hopefully gives you more of an idea as to how to make money from trading the news. The irony of it is you can do it quite simply, providing you essentially select trades of decent profit potential, and you just do it on the higher time frame, risk manage, and of course use a stop loss. Okay, and when you're doing this, when you know full well that the outcome, if you're right, is very lucrative, but if you're wrong, you only lose a small amount, it will help you feel a lot more at peace with the world in your trading, more confident in your strategy. You'll be less outcome attached if you're rationalizing in your mind that, hey, what is the worst possible thing that can happen to me if I take this trade versus what is the worst possible thing that can happen to me if I don't take this trade. Remember, the market doesn't owe us anything. Be optimistic and happy that if we're right 50-50, according to whatever the news is, that we're rewarded well, and that if we're wrong, we lose a small amount. Okay, so one way of doing it, and hopefully this is a theme that you've kind of picked up on throughout this webinar, is we need to separate our head from our heart and kind of remove or replace emotions with logic. It's very important that we do this. Okay, so a simple framework in how to do this is just simply having realistic expectations from our trading. Never afford with money that you cannot afford to lose. That is a big one. Never risk more than 2% of your account's value on a trade, no matter how good it looks. It's so crucial. A lot of people think, okay, well, this trade looked great, I'm just going to risk 10% on it. Whatever. No, do not do that. It's very, very naughty and destructive as well, should I say. Trade setups with positive reward to risk. Use a stop loss and let your winners run. This is a very important one. That in combination will help you know when to this. Okay, so just remember that trading is not a get-rich-quick scheme, and it's all about, if you think of the allegory, the tortoise and the hare, the tortoise actually wins the race in the end. Okay, so trading the daily and the weekly time frame should help you become more at peace with the world and your trading, be more calm, patient and disciplined, and non-outcome attached. That is a big one. Okay, so in conclusion, we could simply say that we do not really care about news because we treat news as a catalyst to help determine the outcome of our trade. If it's a winning trade, 50-50, or a losing trade, 50-50, we know full well that if we're right, we make a good amount of money thanks to high reward to risk setups, and if we're wrong, we lose a small amount only thanks to trade sizing. We essentially piggyback the fast moves in the market thanks to news. Of course, there's no way to predict news the whole time. No one is able to do it, no matter how much money you've got to spend on research as to the long-term or medium-term or short-term fundamentals. It is a mug's game. Some people get it right some of the time, nobody gets it right the whole time, like I mentioned earlier. Okay, so I hope that helps. One thing I do want to do, and once again, I thank Raman very much for inviting us on today. It's always a pleasure to do these things. So as you've made the effort to come this far, I like to reward people who take action. And one thing which we're doing is we're simply giving people who have taken the effort to watch this webinar the opportunity to come on board our flagship Ultimate program, which is valued at $1,997. We want to give you the chance to test it out for $1. Okay, $1 only, that's it. Okay, so what you get access to everything. We do not hold anything back. We'll share with you our trade ideas, market analysis, strategies, both basic and advanced. We give you access to all of our bonuses, like, for example, the Trader Zen audio hypnosis course, which is very popular at the moment, our pattern recognition software, our learning modules. We've got about 20 hours worth of material, very concise, with flipbooks as well. And it's all dedicated in the members area to helping you trade from as little as 10 minutes a day so that you can essentially free up a lot of time and enjoy the fruits of the market without being chained to your desk. One thing we also do have as well is a moderated forum, and you can mingle with other members. Okay. Remember that this is a subscription-based program, so every month it's a $160 charge. Of course, you can cancel at any time, and if you're not happy, we'll just give you a refund, no problem. It's very seldom people do this, but there are always exceptions. So to get your $1 access to this program, then all you need to do is go to the link that will be provided by Raman and buy the Ultimate program, after you click on the link that Raman provides you, use the promo code Venus17, hit apply. That will reduce the number to $1, and essentially that will trigger your password and membership details, and you'll then be a member of our Ultimate program. And we look forward to welcoming you on board. Thank you very much indeed for taking the time to watch this. If you have any questions, do drop us a line, either email Raman directly and she'll forward the questions to me, or email me at rob@thelazytrader.com. Have a great day, folks. I wish you well, and hopefully we'll see you on board the Ultimate program.
We were just learning how to trade the news from Rob Colville. Hope you enjoyed this show and were able to pick out some tips on how to manage your trades effectively around the news. For show notes for this episode, please visit tradingwithvenus.com podcast page, episode 56. You'll find the links that Rob mentioned on the show notes page. I invite you to check these out. Thank you so much for spending this time with me. You are a wonderful audience, and I'm very grateful to have you here. Have a profitable trading week, and I will see you next time.
If you want consistency in your trading, we invite you to join our daily market analysis calls, where we provide the levels to find the best entries and targets on an intraday basis. For a 1-week free trial, please visit www.tradingwithvenus.com. Thanks for joining us today. With much gratitude, your show host, Raman Gill.